Hi, good afternoon, everybody, or good morning, wherever you are in another time zone. Welcome to the webinar organized by the Energy Storage World Forum on the bankability of, or ensuring finance and bankability of energy storage today. We have our panelists ready to go. Almost everybody's there. There's somebody that is still trying to get in. And let me start with a quick introduction of who we all are. Then we do a quick tour of the table. I let everybody introduce themselves, and essentially then we kick it off with a series of questions. Meanwhile, you are more than welcome to also shoot your questions as we go through the discussion into your Q&A entry box. And we'll try to accommodate those throughout the call. We have about 45, 50 minutes ahead of us for discussion. So let's kick it off. Quick intro on myself. I'm Kurt Bays. I'm a partner with Arthur D. Little in the Benelux. I'm based out of Brussels. I work mainly for integrated utilities, demand-side management players, distribution companies, as well as associations on topics that range from strategy over performance management, and a lot of those having to do with growth and with energy storage in particular, where we've published a number of studies, and we're in many projects actually with investors as well as with grid companies. The topics that mainly are touched there are end markets and geographies, which applications, which types of revenue streams, how to stack them, etc. So in that role, or with that experience, I'll be happily facilitating the discussion today. So we have another 3 people here in the group. First of all, Felicity Jones, also Roberto Castiglioni, and then Jim Campion, who is still joining in. So Felicity, I'll give you the floor to make a quick intro on who you are and how energy storage and the bankability of that is touching your business.
Yeah, thanks, Kurt, and good afternoon or good morning, everybody who's listening. So I'm Felicity Jones. I'm a partner at Everose. We're a technical and commercial energy consultancy working across storage and renewables. And we have around 7 people working full-time on storage, doing work right from kind of on the ground, practical site experience, site inspections, witness testing, the system operator, through to kind of feasibility studies, procurement support, and technical due diligence as well. And my particular angle on this is often working at the kind of technical commercial interface of a lot of these projects, and in terms of kind of formal positions, I formally chaired the World Energy Council Storage Knowledge Network, and also currently chair the Markets and Revenue Working Group in the GB Electricity Storage Network. So really looking forward to the discussion today.
Hello, sorry I'm late, everybody.
Very good. Thanks, Felicity. Welcome, Jim. I'll let you catch your breath for just a second. I'll pass on to Roberto for a quick intro. Roberto, floor is yours.
Thank you, Kurt, and good afternoon, good morning to everyone joining this webinar. My name is Roberto Castiglioni, and I'm a Senior Investment Director at Ingenious Infrastructure. Ingenious Infrastructure is a fund manager and investment firm, mainly looking at renewable energy and infrastructures related to the renewable energy industry. We have currently invested in solar, wind, anaerobic digestion, waste to energy, and we're looking at the new technologies coming into the sector, helping, as I said, helping the energy sector, like battery storage, like EV charging station, so on and so forth. In particularly on the battery storage side, last year I created a company within Ingenious called Argonaut Power, and the scope of Argonaut Power is basically to install and operate behind the meter battery storage solutions to C&I customers. So we're very much focusing on behind the meter, and we're very much focusing on medium to large commercial and industrial customers. My background is in banking and private equity. So I spent a few years of my career working at the Royal Bank of Scotland in project finance, Hence, I believe this subject is quite relevant to me because, of course, I spent half of my career structuring project finance and financing for non-recourse projects in renewable and in the energy sector. At the moment, with Renewable Power, we are busy creating our pipeline of projects. So we're busy in creating our customer base and signing framework agreements with developers, but also on our first project, which is quite a decent sized 9 megawatt project, we're looking to introduce debt. And so I'm currently talking to a few banks to understand how to structure the debt, which is not going to be project finance in my opinion, but we can discuss this during this webinar. Thank you.
All right, thanks, Roberto, for that. Jim, maybe a quick intro also on your side, and then we can start it off with the debate and the discussions.
Sure, yes. Yeah. I'm Jim Campion. I'm a partner in Enercap. We're a private equity fund manager based in Prague. Our first fund was 10-year vintage now, and we invested about 100 million equity and arranged all the debt and invested in wind and solar predominantly through Central Europe. That fund is now fully invested, and we'll be going through divestments in the next 6 to 12 months. Over the last year, we've actually been looking at other more direct investments on behalf of large pension fund investors, both in things like cogeneration, also still renewables, but more recently into the storage space. There's a large amount of capital seeking these kind of infrastructure investments, but there's still this unsurety on how storage can look like infrastructure. I mean, we've looked at a number of projects in the UK and Germany, and most of those projects have a very large merchant element. So what we're looking at is to unlock the key that can allow this multi-hundreds of millions of infrastructure type investments to get deployed into storage. So we've looked at various ways. We're trying to get the revenue stacks right to try and at least come with some form of capital preservation case. So that's where we are. We are very interested. We have a lot of capital to put to play, but we're trying to find the business models that can work for large scale infrastructure storage.
All right, thanks, Jim, for that intro. Let's kick it off with the debate, and maybe picking up on what you just said in the last intro. There's a lot of money out there. There's a lot of infrastructure projects out there. How to get them married, I guess, is one of the key questions we're all trying to play with. And maybe on your side, Felicity, what do you see as the main challenges, the main complexities in making that sort of combination work out?
Well, I think Jim's absolutely right. This is all about, primarily the revenue stack complexity. Yeah, and I think we've seen a big transition, particularly in kind of Western Europe, in terms of the winning revenue models. So what you see across a lot of markets is you see a kind of initial frequency response boom. So we've gone through that in GB with enhanced frequency response, latterly with firm frequency response, and we're about to enter that in Ireland as well, and other parts of continental Europe. And that's kind of what I would call kind of battery model 1.0, where you get some kind of reasonable length multi-year contract, perhaps stacking capacity market as well. But it's fundamentally quite a straightforward revenue stack. And what we're seeing going forward is a transition to what I'd call battery model 2.0, where stuff looks a lot more complex, where the name of the game is more about revenue hopping. It's about kind of agility, and really being able to access different revenue streams, like what Roberto's doing behind the meter, whether that's supporting an energy user, thinking about the interface with EV charging. So we're kind of seeing this big transition from one model to a second model, and it's happened really quite quickly, within the space of a couple of years. And I think the big challenge is how you get the infrastructure community comfortable with that second model. So we've seen it just about doable with the first model, and saw some more conservative players enter the space, but and even that was quite a struggle compared with something like a 15-year support payment for a renewables project. But I think that is the key challenge going forward. How do you get comfortable with that new, more complex revenue model?
All right. What Roberto, on your side is the perspective? Indeed, the reference to the behind the meter dynamic, is that the same, and how to to bring the ones that got used to Model 1 now again outside of their comfort zone to Model 2 as Felicity?
Yeah, that's a great question. And when I find a solution, I think I will nail my business model.
You should call me, eh? You should call me as well. Yeah.
I will call everyone. I mean, Felicity is spot on. We are in a transition period where I think we need to still educate the investors community into a new revenue model. Bear in mind that for the last 12 years, 10, 12, 15 years, we've been used to have kind of an easy life when we were approaching projects, because solar and wind, it was all subsidy-based, and so you only had two sources of revenues. You had your subsidy and you had your electricity. And then, if you guys remember, at the beginning of the solar industry, the subsidy was like 90% of all your revenues. So there was very little to understand there. It's a solar plant, this is the production, you get plus or minus 4% every year, and this is your revenue. And it's been like this for the last 10, 12 years. I think we've all become a bit lazy in a way. And now that all the subsidies are gone, we need to start re-engaging our brains to find a way to bring the revenues in a sector that has no subsidies, but offer a multitude of revenues. Like, my approach is different from the front of the meter approach. The behind the meter approach is different because we have decided to be focusing on long-term contracted revenue offered by the customer. And then we will also have the front of the meter revenues. But it has taken quite some time to figure out how we could create a structure that was not too far from what the investor have been used to investing in the last 10 years. It's still not the same as a subsidy solar farm, but we try to create a long-term visible cash flow as much as possible. For the simple reason that when I start looking at this, I start looking at this as an investor. And how can I make myself comfortable with such a revenue stream? What do I need? Is a 2-year contract making me comfortable for the future? No, not really. What can I do to create a long-term revenue stream? And that's what any investor looks at, and that's what any bank, any lender is looking at in order to give you some money.
Okay, thank you for that. And is the push towards more agility, and Jim, you just mentioned in the fund that you highlighted, how does that agility, or let's say the more harsh market environment, translates as opposed to the more cushioned, let's say, subsidy type context of the past?
Yeah, I mean, this transition isn't unique to storage. I think the same process is going through with renewable energy. You know, the investors 5-10 years ago were looking for long-term PPAs, contract for differences, more recently, whereas now and certainly the future, renewable energy will stand alone in the market. And if you look at the large investors in infrastructure are looking at ways to, if you like, disconnect the merchant risk. And so I think you'll get tiers of investors looking at different profiles. And I think the issue here is the level of sophistication. When you're dealing with complex market, balancing market, various forms of ancillary services, to talk about firm frequency response, etc. These are complex markets for pension fund type investors to get their heads around. I think there is an opportunity here for the energy traders who are very familiar and can take the upside of these markets to maybe look at underwriting instruments. We're involved in a project in the UK that was exactly looking at that way. So a sophisticated energy trader is able to see the value and is able to maybe convert a certain amount of that variable market risk into a firm component. Basically underwrite an element to attract in the lower cost of capital that you can get from pension funds and the like. So I think you will see a bit like you could say we're also involved in cogeneration financing. So there people will provide hedges between the spark gap between gas and electricity prices. So I think you will see evolution of those type of processes where the larger sophisticated energy companies that are managing these assets will try and put in instruments that will make a more secure income profile for a certain element of that could get these, particularly pension funds, up. I mean, pension funds are, should we say, learning to accept more merchant risk. They're a bit like a moth to the flame. You know, they get close and pull away, get close. Yeah. But if you want to put a lot of capital to play over the next 10 or 15 years, then, you know, the kind of supported income that they built their portfolios will not exist.
Yeah. Is it similar to what happened to solar then, or is it different? Where should the people looking at the webinar now, how should they see the parallels or the differences? Maybe Felicity, from your perspective, what are the similarities or not?
Yeah, I think if you look at storage, the prime differences, if you look at solar and wind particularly, these are generation technologies. Whereas if you look at storage, is it a generation technology? You know, if you look at the UK, it was considered that way in the capacity market, although it was down rated effectively. I think there are two schools of thought to look at that. In my view, it's not really a generation form of infrastructure. It's closer to the pipes and wires business. It's the form of infrastructure that you'll need on large scale in our grids today to adopt more wind and solar, et cetera, as we know going forward. So at the moment, it's in that hybrid space. And I think you may find it might be better suited to get the billions of euros and dollars that's necessary to get this infrastructure up. It will need to look more like infrastructure, certainly the larger parts. So it's more almost like regulated asset base, where the utility, the grid companies that are responsible for grid stability should possibly take a play. But at the moment, it's more, as you say, closer to solar. It's been seen as closer to a generation technology. It's closer to a merchant asset. And I think the question I raise is that the right approach if we need to install multi-billion euros of energy infrastructure storage over the next 5-10 years or so?
So that's a call to the regulator in a way.
Regulator or basically whether it's at network distribution level or at transmission level, it's probably more at distribution level, but it's more of an asset that's necessary to provide that distribution infrastructure and transmission infrastructure. And who pays? Ultimately, the consumer should pay. But I think to deploy it at the rates that it should really be deployed, it's going to be very difficult to be done on a merchant model, unless you have these energy traders that are able to provide that comfort and provide an underwriting approach to attract the infrastructure investors.
Yeah, so certainly from my perspective, and I suppose trying to bring what everybody said together, I see there are possibly three directions of travel, and probably all will be pursued. Number one would be, what Roberto's doing, which makes a lot of sense, really looking to the energy user to provide that kind of long-term revenue visibility, which is, picking up on your question, Kurt, about the analogy with solar, that's a bit like a corporate PPA, getting that kind of certainty. So that's one option. The second option would be just accept it's very merchant and have higher risk capital, which, some people go down that route. And then the other one that Jim's raising in terms of, is it a trader or an aggregator or, whatever kind of quite label you want to put to it, somebody's coming in and taking that risk. It certainly takes a lot of confidence to do that. I think at the moment, given how much reform we're seeing in our ancillary services market, how much how much we're expecting, a lot of disruptive technology to come in and change and regulation to change our balancing market kind of dynamics. So I think it takes a bit of stomach to take that risk, but I think people will step in and take that risk because certainly if you look at the aggregation space, taking GB as an example, we've got 20 registered aggregators. They're struggling to differentiate on their products, and it's looking a bit like a race to the bottom. So I do think some people will kind of step out and say, okay, we'll offer something a bit different, we'll shoulder a bit more risk, and then perhaps getting in the lower risk capital. And I think we'll see all three of those models kind of be pursued.
Mm-hmm.
Yeah. Is project finance a viable option? Roberto.
I'll take this, given that I probably start my career with project finance and live within project finance since the start of my career. Project finance, the way a purist would define project finance, I don't think today is available. But the banks that were involved in project finance, in particular banks that were involved with power and infrastructure, they're starting to look at this, because after years of funding projects that could rely on government subsidies, so basically taking government risk, they basically starting to see that the market is moving towards an unsubsidized revenue model, and if they want to still be deploying their capital, they need to understand that merchant risk is again on the table, and these banks used to take merchant risk. At the beginning of my career, 17 years ago, I used to work on big CCGTs projects, power plants, oil and gas, and we were taking merchant risk. So what I said before, that we became lazy, yes, now everyone thinks that, oh, everyone is scared about merchant risk, but we used to take merchant risk years ago. So the banks are now looking at it. Now, project finance, I don't think project finance the way we used to see will be available, but for battery storage, financing like mini perms will probably be a financing more suitable to the cash flow of a battery and also to the life of a battery. Let's not forget that these batteries may have a life of 10 years, 12 years, 15 years if you're using lithium ion, or you can go up to 20, 25, 30 years if you're using flow batteries. Then if you're doing standalone lithium, the life of the project is probably very limited, so you maybe get away with a mini perm. But if you're doing flow batteries next to a generation facility that could be solar or wind, so co-location of storage, and the life of the PPA is 20 years, the life of the batteries are under 20, 25 years, then at that point we can talk about something that looks like project finance or something that is, in fact, project finance. But we're still not there yet. Banks are still getting comfortable with. I'm talking to a couple of banks now for potentially funding our first project, which is a behind-the-meter standalone, so there's no generation on site. And they're very interested, and I believe we will get there, but of course, you will not be able to see the good old project finance tenor. You will not be able to see the good old project finance leverage of 70%, 80%, if you're lucky. But we'll probably see 5 to 7 year mini perm structure with 30 to 50%, I think, leverage.
Okay. When looking at the revenue streams, which is sort of the $1 billion question, looking at a storage project, can the revenue stack actually achieve the secure capital preservation case? So can you make sure on the risk profile that you're right? Is it a risk profile that can actually attract, in your view, large scale investors, structural big investment vehicles? What's your perspective, Jim?
Sure. Yeah. Touch on something that Felicity said. The rate of change has been very quick in the environment, the legislation and such like. We started looking at some UK projects about 9 months ago, and the revenue stack changed fundamentally from 9 months to 12 months ago to 2 months ago, with firm frequency response fading away, with the capacity market, both on price and how it was considered for batteries fading away. So that's been the challenge. When we first looked at this, I would say nearly 12 months ago, we looked at it with a view to yes, that actually there was sufficient revenue stack with sufficient comfort we were looking for a capital preservation case. And also interestingly, you can look at the asset itself, that batteries are a lot more mobile as a system than building a combined cycle plant as I used to do. So if you've got some asset value, your worst scenario is you can physically move it, providing there's another market you can move it to that's going to make money, which is another caveat. So initially, yes, but we saw a lot of changes particularly in the UK in the last 6-7 months or so that made that very difficult to achieve that stack. We did enter into dialogue with a couple of energy trading companies to provide some form of underwriting, basically a floor on some of these markets, and that did make some headway. So I think I'm optimistic over time that I think the instruments will get in place. Non-recourse project finance is difficult. It looks very different to, say, that certainly the subsidized renewables, or even the combined cycle plant. Like Roberto, I have a background in combined cycle plants 20 years ago, and we could get non-recourse project finance with a certain merchant risk, although that was the structure of those things, how the cash sweeps work and such were quite expensive. The projects we were looking at UK would have been all equity, interestingly, by a large pension fund investor that would look at that structure, and the yield that they could potentially get back was worth it. And if you go limited leverage, it's the cost of arranging that finance and the covenants that come with, provided you have sufficient capital, were not attractive. So I think the question is, at the moment, it seems very volatile. So you need a certain stability, if you like. It's the key word for pension type investors is stability. But I'm optimistic that I think structures will come into place, because there's such an opportunity here if people can structure this right. The other problem I see, talked about solar. What happened with solar when the price, as it continues to go down, collapsed, is that you invested at a certain time at a certain supported feed-in tariff. You were confident, or you knew, apart from certain countries, that you had that tariff for, say, 10 or 15 years. And you were protected against the guy coming 3 years later with a lot cheaper cost of system. Now, everybody's seen these forecasting batteries falling, whatever curve that will be. So if you invest today on an unsubsidized market-based system, you're potentially at risk of the guy coming 3 years later with maybe 30% less capex than you have. So it's hard to get a defended position. So that was one of the other concerns we had in looking at this sector today. The large amount of volatility and that cost curve risk. At what point do you invest?
But I think a lot of that volatility comes from people having targeted what are actually quite small markets, frequency responses. Yes. Ancillary services are ancillary, right? And so, of course, that market saturation risk, it hits the market, very quickly. I think trying to be a bit less pessimistic, in terms of, is this bankable? On the more positive side, I think the technology absolutely is. I think there are some concerns, or there have been some high profile cases that have made a few people nervous, like the fire in Brussels a few months ago for a battery storage system. But fundamentally, this should be a technology that, if you do your homework, you've got, EPC with a good track record, you've got a robust battery capacity warranty. Banks should be able to get comfortable with the technology. So that is on the positive side.
Yeah, keeping on going on the positive side, right? That's ultimately what we need to do. There's different stakeholders, and Felicity, what is your view on the different stakeholders? I have on my list the project developer, the technology provider, the lender, insurer, but also any others that are. How do they look at this from their own particular stakeholder perspective, in your view?
Yeah. Okay. So I think we've seen initially a lot of developers make the mistake of thinking this is like solar, and think that this is all about the land grab, getting land, getting planning, getting grids, jobs are good, and flip it on. And there's been more recently, realization actually that's obviously an essential step, but a lot of the value add is coming a bit later on in the process, all around this revenue strategy. So I think developers have kind of been making adjustments to their approach and kind of getting a bit more proactively involved later on, because they have to. I think another stakeholder that's really interesting is the aggregators, and more generally the parties who are providing the energy management system that dispatches batteries. And I think what's particularly interesting is that could be done on a single asset basis, or those batteries could be integrated as part of a virtual power plant, a VPP. The kind of contractual arrangements around that can be quite complex. There's kind of counterparty risks that you can expose yourself to, but I think it's perhaps a signpost to where batteries will be viewed in future, where it's not just about how do I make the most out of this asset, but how do I make the most out of the particular techno-economic characteristics of batteries, and how does that fit in with other assets that perhaps have a longer duration at a more competitive rate.
Okay. And on the VPP notes, we're just actually concluding in ADL some research on VPP and how a battery fits in and the uptake of batteries into the portfolio. And it's quite interesting to see the shifts, also looking at UK, and how aggregators there are, let's say, I think you named it run to the bottom at some point, really also struggling with that or dealing with that. Another, let's say, very pragmatic question that I would like to ask to all three of you. The do's and don'ts. What are the do's and don'ts when it comes to trying to finance a battery storage project or asset? Roberto, what's your take on that?
Well, the do's, probably one rule that I always apply when we develop project is always from the beginning, develop a project in a bankable way, in a bankable fashion. Do not let the developer structure a project that then needs to be taken apart and rebuilt because it's not bankable. So from day one, you need to make sure that the customer, in my case, I'm talking about behind the meter storage, so it's a bit different from the front of the meter. In my case, for example, a customer needs to be a credit-rated customer. Of course, if it's investment grade, even better. If it's not, at least a customer that has a healthy balance sheet. There's no point of coming with a pipeline of 20 megawatts of projects to customers that I believe will leave the country in the next couple of years because Brexit and everyone is going to move production from Great Britain to the continent. It's the small things that then really decide the life or death of a project. If you structure a project, keeping in mind some bankability issues, then for sure you will have return on your equity. Whether then you bank it or not remains to be seen. But if you make it bankable from the beginning, for sure you will receive a return on your equity. Another deuce is, I think, especially for battery storage these days, make sure that you have the right advisor and the right people next to you. Because it seems like today everyone is an expert on battery storage. While 2 years ago, no one knew about battery storage. And it's important that you have people like Felicity on board and that she truly understands battery storage on its own and has spent a lot of time analyzing various options of battery storage, various revenue streams, understands the regulations, so on and so forth. That applies to advisor, but also to suppliers and also to contractors. Do not go with the first one that comes along, the first contractor, but make sure that your contractor understands how to install the battery storage system, how to, connect to the grid, how to maintain a battery storage. The same applies to aggregators, for example. Felicity just said that there are 20 aggregators registered now in the UK, which I only know of 10, and I thought I knew them all. So, to me, it means that out of these 20, it's probably a good 50% that we will not see them again in 2 years. So make sure that you get the expert in the field when you're about to get into a new sector like storage. And let me tell you one thing, it's got nothing in common with solar. Nothing.
Yep.
If you think, I've done solar and wind, I can do storage. Think twice.
We acknowledge your plea, Roberto. We acknowledge your plea. I guess that's the don't, right? Don't think it's it's
yeah, the donkeys don't think it's as easy as solar and wind.
Yeah, Jim, what's your take on the do's and
completely
don'ts?
agree. I mean, we were approached by probably 7 or 8 different developer groups in the UK, each developing somewhere between 50 to 200 megawatts. I think the barrier to entry was perceived low. There was this solar mentality: find a site, find a grid connection. And I think a lot of people actually spent quite a lot of money not understanding the sophistication of this market. So taking good advice and understanding what you are actually developing and the value streams of what you're developing, particularly in a fast changing market. I mean, we know people that have literally acquired or paid options for sites, charged away in the boom, without really understanding the market that they were trying to raise the capital for. Also reiterate then, if you do have the right advisors, you have a good business case, make sure the development is bankable, irrespective of whether it's an all equity type investor or a bank. The thresholds are the same. The quality of the development is the same. Again, I've seen some terrible financial models that people have pinged towards and said, this is why we're worth £20 million. So I think the quality was somewhat disappointing across the range of things. Not in all cases, there were some very good cases as well. But I think that's the commonality with solar, that it was a fairly low threshold where people perceived they could get in on the basis of a site and a grid connection. So quality over quantity, I think, would be my comment.
The guideline. All right, thanks for that. And Felicity?
I think it's important to think about kind of revenue resilience and kind of optionality right from the start. And partly that's about picking a good site. So if you're behind the meter with an energy user, or already you've got somebody else you can serve, so there's a kind of resilience to that, even though there's an extra complexity. But it's not just picking a good site, it's thinking more generally about kind of system design, making sure that when you're drafting your employer's requirements, actually you're thinking not just about what you're going to be doing years 1 to 2, but 10, 15 years later. And really thinking about or investing the time to negotiate a battery warranty that delivers what you're going to need. So I think perhaps some of the early projects have, because they had this kind of frequency response mentality, perhaps signed up to battery warranty terms which are perfectly brilliant for frequency response, but actually if you wanted to move to something like a balancing mechanism mode of operation, where perhaps your average state of charge would be different, or the depth of discharge, or the kind of just the intensity of the cycling and the number of kind of megawatt hours going through your battery every year, that kind of change in operation might actually be inconsistent with some of the warranties that people have signed up to. So I think right from the start, investing the time to understand, what am I asking for my EPC and my battery OEM, not just now, but what might I need in future, I think is really important.
So taking the longer term perspective, actually, and the time horizon beyond the short term, cutting the deal. Do you see fundamental differences between the larger or the smaller investors from a perspective of one could be more, let's say, utility that goes for it full blast and also needs the financing, versus more, let's say, the project-focused investor? Roberto, do you have a perspective on the large, small dynamic and how those would be altering the do's and don'ts potentially?
Yeah, more than large and small, I would say different kind of investor. And you rightly mentioned utilities. Just look at what happened in the UK on the EFR. Sorry, I just muted myself. On the EFR bid, 200 megawatt of EFR enhanced frequency regulation assigned. And if you look at these projects now, they're all in the hands of utilities. The bids were between £7 and £12. We tried to bid on it as an investor, different kind of investor, not a utility. Our threshold was around £16. So it's about having a different approach, a different investment strategy. Utilities, they've invested probably decided to make little money. Also, their cost of capital is a lot lower than my cost of capital, of course. But they're doing this for a strategic reason. They want to be in the market. They want to have a big EFR battery in the UK because it's the first market to auction that, and then they can use that knowledge all around the world. Now, my approach is different. I'm not after the strategic position, I'm after the return. And so that's the reason why I decided to leave front of the meter, and I decided to go behind the meter, because that, in my opinion, gives me probably a better return, or at least a better risk-return profile, which is a profile that I know is good for my investors. So it's not necessarily about size, but it's probably more about risk appetite and strategic reasons.
Yeah. Okay. What about funds, Jim? You are very close to that. We saw in the press, Bloomberg, I think it was a week and a half ago, a new fund exclusively on storage being launched, Gore Street Capital in London. What's the role of funds in this in this story?
I think certainly you could wind back to when the renewable funds started, maybe 15 years ago, I'm guessing, maybe even longer. Once an opportunity opens, there is always capitals looking to back good fund managers if they can find a sector. I think the challenge will be in those funds, where in the spectrum are they seeking to invest? I agree with what Roberto says. I think behind the meter is well suited to more venture type thinking investors looking for a slightly higher return. The investors that we're dealing with, interestingly, not as funds, but as directs. And that's also a change. I mean, 10 years ago, we raised a fund. Our lead investors were EIB, EBRD, range of other typical fund type investors. When we looked at the market 2 years ago, whether another fund, it seemed that the larger investors, the pension funds, insurance companies, wanted to do direct investments, still managed by somebody that in principle understood the sector and still placed the capital to manage all the assets. But you could raise 300 or 400 million from a single pension fund investor that would previously taken 6 or 7 investors into a fund. So there has been a change of infrastructure seeking direct investments, and that goes in cycles. So for sure there will be funds, medium scale funds that can probably find that space, and particularly if they're able to invest across the spectrum, supporting the sort of work that Roberta is doing, or directing the infrastructure. Interesting his point on strategics, because we've had a number of dialogue with strategics, utilities basically, and I think you're right. They are making those. They're in the learning curve. They're needing to understand that this is going to be a significant part of their business in the next foreseeable future. So they need to understand. So they make investment decisions on a different basis. Interestingly, we are doing roles of partnering with some of these utilities, bringing a lower cost of capital. So if you're looking to deploy capital, one safe way to do it is to take a minority position underneath the sophisticated operator of the asset. So you can either do that through financing instruments as a direct asset holder, or you're coming alongside them. And I think that's how you will see certain substantial investments into this space, and that relationship, who carries that risk in that relationship. We're having discussions, quite advanced discussions, both Germany and the UK on that basis.
Yeah, and picking up on that, what is your advice to the utility, if we take the utility now as a, let's say, a less typical stakeholder in this type of discussion? What is your advice from what you see to them?
To the utilities, that's interesting. They're obviously, on a no-names basis, the ones that we're dealing with at the moment. They do have be careful what I say here, I don't know who's listening, sort of in some cases, lack of understanding, because you're not dealing with corporate treasury, the people that are raising the bonds and financing the business. You're often dealing with those at the project phase, the people that are developing power plants and other infrastructure assets. So they have a very sort of strong technical focus and understanding, but less experience in financing with third parties. And so you find yourself sort of going in loops a little bit on how to get a structure that works for third-party capital there and preferred income streams. Because if you're looking for a lower cost of capital than internal corporate capital, you need to have a protected income stream. So I would sort of advise them to probably get their M&A type people and financial specialists down into the project teams early, because sometimes they've got further advanced on something and then say, oh, now we'll finance it. And they've done it arm's length away from the sort of the corporate center and understanding their cost of capital internally. So, and I think that's probably the structure. They tend to be working, in my experience, too much in pillars and probably not more joined up at the beginning, saying we will raise 200 million to fund this with a partner and start there. So you can structure it accordingly.
Yeah. Okay. Continuing with the advice role, what about the advice to the grid operators, and also and there's a question here coming in on the webinar sheet. How can it actually be viewed as solving network issues in terms of congestion or other? And then the trade-off between building a transmission line or putting in batteries at either end, and the bankability of those two solutions actually.
Yeah, sure. So I think, so when we talk about grids, we can talk about system issues, like frequency response, or we can talk about kind of constraint or issues, the more local challenges as well. And the vast majority of battery deployment in Western Europe has been all about kind of solving the kind of system-wide issues. And I think the person who's posed the questions makes a really good point. Perhaps we could use this as an alternative for wires potentially to deal with local constraint issues. I think we definitely will see that happening. So taking GB as an example, we have the Open Networks project, whereby you've got all of the DNOs getting together and trying to figure out how do we create new flexibility markets and look at third-party provision of flexibility really from different sources that aren't wires. From a battery perspective, there are a few challenges. So I think people really need to be aware. Firstly, a lot of the challenges that DNOs face can be quite transient. They can be quite short term, and that can sometimes not match so well, the asset life of a battery. And secondly, the other thing to be really aware of is really high reliability requirement. So something like EFR, FFR, you see a kind of 95, 96% kind of requirement there in terms of performance. But if you're competing with wires, well, wires have 99.99%, reliability. So it's really, it takes a lot of persuasion, for a DNO to kind of procure this service from something that's seen as less reliable and is less reliable. So I think we need to think about things like, well, perhaps, rather than totally gold plating our battery systems, thinking about, can we just procure a bit more flexibility than we'd otherwise need and kind of spread that risk across the portfolio? But I certainly think that's going to be the challenge. There's going to be a lot of scrutiny on reliability. And I think we've seen, with even the first frequency response projects, that there's been certain challenges in getting EPC contractors to take on full risk. So we're going to see that as being even more tough when we look at DNO level services. But it will happen. I absolutely believe it will happen.
Yeah, and going then to the timing of that, because ultimately the cost curves of batteries are what they are. We're bringing out a study in about 3 weeks actually on technology in batteries, and there it's pretty clear what's happening to the cost curves, and I think everybody's aware of it in the market. Does that push financiers away a bit in terms of, I'm waiting to jump on the bandwagon because this thing is falling down in cost curves as quickly as I've seen it with certain other technologies? I don't want to talk about solar again. How is that putting additional stress to the bankability of projects, this declining cost curve? Roberto, do you have a perspective?
I don't buy the argument of waiting, and investors behind this, they ask us, why don't you wait and next year? But first of all, next year you will be asking me the same question, why don't you wait the next year again? Because if prices are falling, then let's all wait and don't do a project. At that point, price will not be falling. So it's a bit of a catch-22 situation. But nevertheless, there are some barriers to entry, especially batteries more than solar. Not every piece of land in the country is good to install batteries, especially for behind-the-meter batteries. The good customer will be gone in 2-3 years. Mm-hmm. Because the first customers to go are the ones that are credit rated and the ones that really need batteries. And then you go, we have a list of preferred customers, preferred CNIs, tier 1, tier 2, tier 3, and once we're done with tier 1, we'll focus on tier 2. Once we're done with tier 2, we'll focus on tier 3. If you start in 3 years, you may be in a position of only relying on customers that are not probably the best customer to have in your portfolio. But also, what about the loss of experience and data that you can collect in the next year or two? And I think that's key, especially in a market that is new, relatively speaking, to everyone. I wish I started a year before, because by now I would have installed a lot more and I would be collecting a lot of data and understanding a lot better how to manage the battery. So I don't buy the argument of wait because prices are going down. And by the way, Kurt, probably you're the best person to say prices are not falling as we expected 2 years ago.
No, that's true, yeah.
So
it's a window of opportunity which is more dominant than the perceived price decline in your view. All right, thanks for that. I'm moving towards the sort of the closing questions. There's a very interesting, let's say, dynamic always coming up in financing. And one example was the Agrico Unicos how to lease a battery type thing, which creates another dynamic on also the financing of the projects. How do these things come into play? Jim, from your perspective, have you seen them? Is it going to fly? Doesn't have anything to do at all with this? What's your perspective?
Give you, yeah. I mean, sort of, you're probably aware that leasing's heavy in play on mobile power, people like Agreco, people like that. So when you've got a piece of plant that you can physically move and lease and move the assets. So on that basis, you could argue that batteries are suitable for leasing. As I mentioned before, if a particular site or situation isn't economic, you can retain a large amount of that asset. It could be quite interesting for behind the meter type projects where you say that a client may have a 2, 3, 4, 5 year life cycle where that suits. So I could see that being a sort of, it's more like a service financing structure than a project financing for that way. So I think there is space. I've not come across it as yet, but I could well see a situation where that is viable because of the type of asset that it is. Also, well, we're talking, just cover one point previously on the price curve point. We did actually look at that when we were modeling some investments, what happens now versus 2 years and 3 years. And our view basically is that we were looking to do investments in a platform organization that would do a series, in which case it's worth taking that first investment, not waiting for that learning curve and that experience. If you look in isolation as a single investment, it becomes less so. If you look at your IRR and if you could acquire the CapEx, there's a curve at a certain point that it doesn't accrete the IRR, it reduces. But as a business, if you're looking at a venture and a platform business, it doesn't make sense to wait, in our view.
Yeah.
One quick point on the lease that probably good for behind the meter. One thing to consider for CNI customer is what's the level of understanding on the revenue stream, on the revenue stacking. Because if CNIs get into a lease, they still have to understand how to stack the revenues of a battery, how to operate a battery, how to liaise with the operator release. Other ways of funding battery storage is exactly what we do with Outlook Power, which is basically we provide CapEx-free solution under an energy-saving agreement. So the customer is basically taking the benefit of an ESA, of sharing the savings, without putting the CapEx up front. So it's not just lease or project finance. There are in the market other solutions whereby the customer is taking the benefits, but an investor is paying for the CapEx and the OpEx.
Yeah.
Yeah, I mean, certainly I expect to see growth in storage as a service business models. And I think we're going to see, and already starting to see, activity there, particularly at a domestic scale, and people looking at that kind of portfolios for residential sites, that could be energy suppliers. I think the key thing for me is if you're having a storage as a service model and you're alongside an energy user, it's just making sure that the incentives are really well aligned, not just for the revenue stack now, but for whatever's coming. So, for instance, in GB, Ofgem published a paper in November which basically will change the way that forward-looking charges look. So that kind of changes the business model for behind-the-meter storage. So how do you make sure that whatever contractual setup you've got, that those, that somebody's not getting ripped off, and that the kind of revenue risk or the kind of the upside is really clear to everybody and fairly allocated, and also that you're not constrained to a certain revenue stack as well. So I think that's the key thing, and I think that the big challenge for behind the meter, though I think it's surmountable, but the big challenge is when you've got so many parties involved, an energy user, potentially an aggregator, EPC, perhaps a developer, perhaps an investor, it could be quite a lot of people. How do you make sure those risks and the upside is clearly and fairly aligned?
So it's almost portfolio management in a way. I see here a couple of open questions. Unfortunately, we're not able to handle them anymore. I would encourage everybody to go to Berlin in the month of May and debate with the panelists here, who are, I guess, all going to be there in the forum. To pop them out. There's questions on insurance, how it can fill the gap, also on the lead times, etc. But I guess I suggest to those that have asked the questions to pick them up, take them to Berlin to the forum, and debate them over coffee, wine, lunches, and dinners in the storage community. I want to thank all of the panelists here. Thanks for taking the time. I hope those that have looked at it or will look at the recorded version are having fun, and thanks for your contributions today.
Okay.
Thank you very much.
Thank you, everybody.
Thank you.
Yeah. Good afternoon to all.